Hello and welcome to another Software and Internet Monthly Market Report brought to you by Sanford Advisors, where we'll be talking through monthly M&A and capital raising transactions and trends. So we'll start on the M&A front. So for December 2022, we saw $16.4 billion of money invested, and about 50% of that actually came from one specific transaction, which was Thoma Bravo's $8 billion acquisition of Coupa Software, and that came in at a revenue multiple of 10x roughly. And then in December 2022, we also saw 94 transactions, which was the lowest of any month that we've ever seen in recent periods. And then across those 94 transactions, we saw a median revenue multiple of 1.7x, which was also the lowest that we've seen in recent periods as well. So if we turn over to monthly trends, we've been talking about this a lot. We've definitely seen a big drop off starting February 2022, obviously because of the war in Ukraine and then the changing macro environment. And from February 2022 to now, we've typically seen about, let's say, an average of 120 transactions per month. And that's essentially the new normal for this post-pandemic period. In December 2022, we actually saw a pretty sharp drop off to 94 transactions, which, as mentioned, was the lowest we've seen in recent months by a fair margin. And part of this can actually be attributed just to December being a slower month, generally speaking, because of the holiday season, people taking off for holidays early, and then also just maybe to some extent a continuous rise of interest rates, which have impacted the tech markets more than other defensive industries as well. Now, if we look at how 2022 finished the year as a whole, we actually see some really interesting trends here. So first, if we look at dollars invested for the year, there was $441 billion throughout the year, and that's essentially a new record by a large margin. However, if we look at the actual transaction volume in 2022, it's down moderately from about 2,300 to 1,850. So what that's basically telling us is that buyers and investors have been focusing on much larger deals in 2022. And that's not at all a surprise with all the take privates we've seen by some of the large private equity funds this year. I think if you look back at the last 2 quarters, we've seen more take privates in the software space in those last 2 quarters than we have in any other quarter in the last 10 plus years. Now, if we turn over to valuations, we've seen a consistent decline in the median revenue multiple from Q4 2021 all the way to Q4 2022. In 2020 and 2021, we saw quite a lot of variability in the revenue multiples, and that's evidenced by the big spread between the 25th percentile and the 75th percentile. In 2022, we saw that tighten up a little bit, and we saw less variability in the multiples, as well as median revenue multiples declining. But in Q4 2022, that spread did start to increase a little bit, and we are starting to see a little bit more variability. Now, if we look at this in a slightly different way on an annual basis, and we break this down between SaaS and non-SaaS, and when we think of non-SaaS, it's typically a perpetual license plus maintenance and support business. We see some interesting trends here too. So SaaS obviously dropped sharply. It went from a median revenue multiple of 8.6 times down to 5.5 times. However, if we look at non-SaaS, that's been on a consistent uptrend since 2019. And over the same period from 2021 to 2022, we actually saw non-SaaS multiples increase from 4.4 to 4.9. So it's really tough to pinpoint what's causing the increase in multiples this year. Part of it could be that investors and buyers are looking for additional avenues of growth, and they see, a perpetual license plus maintenance and support business grow, or they see converting a perpetual license plus maintenance and support business to a SaaS business an additional avenue for growth. But also cash flow is much more important now in 2022 as well. And oftentimes these non-SaaS businesses are much more mature in nature. They're often profitable, and that can also be playing into some of the higher revenue multiples as well. So now we'll turn over to the VC highlights. So in December 2022, we saw $3.6 billion invested across 337 transactions. The median deal size across those 337 transactions was about $3.1 million. And we'll get into some of the trends on the following pages as well. The first, we'll go over to monthly deal counts. So we see some interesting trends here, somewhat consistent with M&A, where we have seen a decline in deal counts and starting in February 2022, but it seems to show a more consistent decline than M&A, whereas M&A is a little bit more bouncy. And then obviously in December, we saw about a 40% decline in deal counts from November 22, and that's much sharper than the decline in deal counts than what we saw in M&A. Again, part of that is because December is just naturally a slower month, but I also personally think some of this is because of the continued rise in interest rates and that having a much greater impact on VC-backed companies than bootstrapped businesses. So now if we look at VC as a whole, we broke a new record just in terms of monthly deal volume. We finished the year at about 8,300 deals, did 7,500 last year, so quite a fair increase. But if we look at the actual deal volume or the deal value, it's down about 15% year over year. We finished the year at $97.5 billion, whereas last year we finished at about $115.4 billion. So what that's basically saying is that there's a larger amount of transactions happening at a smaller deal size than what happened in 2021. If we look at valuations too, we also see a lot of interesting trends. So mid and late stage deals have been on a steady increase in terms of valuations, and some of the multiples here too for mid-stage deals are still very elevated. 2022 finished at a median revenue multiple of about 41x for mid-stage deals, which is the highest it's ever been over this period of time that we're measuring. Same with late-stage deals. They finished at about 26 times, which is again the highest they've ever been. But if we look at early-stage deals, those have actually declined year over year from 33 times down to 29 times, which somewhat shows a risk-off mentality because a lot of those earlier stage deals are inherently more risky for VCs. So that's all we have for this month's monthly report. If you'd like to be signed up for one of these reports, feel free to contact anyone on the team and we would be happy to add you on. But that's it for now, and thank you for listening.